the global credit market is undergoing a quiet but profound transformation. We're talking about an asset class that has exploded in size since the 2008 financial crisis, now rivaling some of the world's most mature debt markets. It currently holds over $1.7 trillion in assets, with projections suggesting it could double again by 2028. But this rapid growth hides attention, a market that thrives on opacity, illiquidity, and high leverage. When a high-profile corporate bankruptcy exposes billions in hidden debt, as we saw recently with an auto parts supplier, it raises a chilling question. Was that isolated failure just a singular event, or the first sign, the cockroach in the coal mine, indicating that deeper financial vulnerabilities are starting to surface? Today we delve into the world of private credit, exploring the trends that propelled its rise, the compelling benefits it offers, and the fundamental risks that could challenge the entire financial system. To understand the stakes, we must first define the player. Private credit, or direct lending, refers to debt-like instruments provided by non-bank financial entities, such as private credit funds and alternative asset managers. Essentially, it is lending that takes place outside the traditional channels of commercial banks and public debt markets. For borrowers, it offers an alternative to conventional bank loans or issuing corporate bonds. These agreements are bilateral, negotiated directly between the borrower and a small group of lenders, meaning the terms are customized for specific needs, often without the strict public reporting required in open markets. The core of this activity is direct lending. These loans are typically structured as floating-rate debt and often have a first lien seniority, generally protecting the lender's position in the event of a default. The scale of this shift is difficult to overstate. After the 2008 crisis, the industry expanded dramatically, growing from approximately $1.7 trillion in assets under management by early 2023, with some estimates placing the total size around $3 trillion. North America and Europe remain the primary focuses of this market. This places private credit on par with other mature credit markets, specifically the U.S. high-yield bond market and the broadly syndicated loan market. However, unlike those public markets, this vast segment of corporate financing operates largely in the shadows. The exponential growth of private credit was driven by a potent mix of regulatory push, investor pull, and advantages sought by borrowers. Regarding the former, the primary catalyst was the post-global financial crisis regulatory reform. Stricter rules, such as higher capital requirements for banks, were designed to discourage them from taking on riskier loans. This led to a substantial retrenchment by traditional banks from areas like mid-market lending and highly leveraged finance. Private credit funds effectively stepped into this vacuum, absorbing the loans that regulated banks were unwilling or unable to make. This shift is seen by some industry leaders as beneficial, arguing that moving credit activity away from the highly leveraged banking system effectively desecuritizes the financial system. However, experts worry that ongoing regulatory changes, such as the proposed Basel III endgame, will continue to accelerate this migration of credit from regulated banks to less regulated private lenders. As for the investor pull, following the crisis, central banks kept interest rates near zero for years. This environment made the returns from safer government and corporate bonds highly unattractive, sparking a broad search for yield among institutional investors. Private credit offered these investors, notably pension funds, insurance companies, and sovereign wealth funds, access to higher interest rates coupled with an illiquidity premium, often 300 to 500 basis points above comparable public debt, intended to compensate for the reduced liquidity and transparency. Insurers, in particular, have substantially increased their allocation to private credit, recognizing its potential for long-term returns, compatible with their extended liability horizons. For middle-market companies, often too large for a single bank loan but too small for public markets, private credit offers compelling advantages. First, private lenders provide speed and certainty of execution, completing transactions faster than banks or public offerings. Second, they offer customized lending terms that provide flexibility, especially in times of stress. Third, these transactions are confidential, avoiding the rigorous disclosure requirements of public markets. This financing is directed toward firms often deemed too risky for highly regulated banks. However, borrowers pay a price for this flexibility. The interest rates on private credit loans are typically higher than yields for market-based alternatives. The characteristics that define private credit, its bespoke structures and lack of public disclosure, also represent its most significant vulnerabilities. Unlike transparent public markets, the private credit ecosystem operates in near opacity. There is minimal public information available regarding the financial health of the borrowers, the specific terms of the loans, or whether those loans have been amended or extended. This lack of visibility severely hampers the ability of investors and regulators to accurately assess the underlying credit risk and monitor potential links to other parts of the financial system. Regulatory attempts to mandate greater transparency, such as rules proposed by the U.S. Securities and Exchange Commission, have faced legal setbacks, highlighting the industry's resistance to extensive oversight. The illiquid nature of private loans means they are rarely traded, making valuation difficult. Consequently, they are often marked to model, relying on internal or third-party estimates that are inherently subjective. This valuation structure creates a conflict of interest, particularly since fund managers typically charge management fees based on the net asset value of the fund. Managers may be incentivized to maintain or inflate NAV figures, even if the underlying loans are deteriorating. This can lead to a delayed realization of losses. Evidence suggests that valuation adjustments in private credit are smaller and slower during market shocks compared to public markets, potentially masking the true risk profile of the assets. This uncertainty regarding valuations could ultimately erode confidence in the asset class during a downturn. A notable trend compounding valuation concerns is the increased use of payment in kind, referred to as PIK arrangements, particularly in high interest rate environments. PIK loans allow struggling borrowers to defer cash interest payments by adding the owed amount to the loan principal. While this provides immediate liquidity relief to the company, it effectively compounds the borrower's debt burden over time, amplifying the risk of default down the line. The reliance on deferred payments can thus mask underlying financial instability within the portfolio. These structural weaknesses, including deficient valuations and undisclosed risks, create fertile ground for legal disputes. Because investors have limited visibility into loan terms and borrower health, they are highly dependent on manager disclosures. If management fees are tied to inflated NAVs, it could trigger claims of mismanagement or breaches of duty against fund managers. Given that lending decisions are more readily scrutinized against established standards than equity investment decisions, private credit fund managers may face increased liability risks compared to their private equity counterparts. The nature of private credit borrowers and the funding structures used across the ecosystem introduce major credit and liquidity risks. Private credit borrowers are often characterized by being high-leverage, middle-market companies. They are particularly vulnerable to interest rate shocks because their loans are almost exclusively floating rate. This means that a rise in benchmark rates quickly translates into higher interest burdens. Crucially, the private credit market has never experienced a severe economic downturn at its current size and scope. If a severe adverse scenario were to occur, it could trigger a spike in defaults and subsequent valuation markdowns. Despite the risky profile of these borrowers, historical default rates for private credit have generally been low, attributed partly to lenders monitoring borrowers through covenants and having the flexibility to renegotiate terms. However, this low default history may simply reflect the benign economic environment of the last decade. While private credit funds often boast lower leverage than banks, the system as a whole contains multiple layers of interconnected leverage. Borrowers are highly leveraged, often backed by private equity sponsors. The funds themselves employ leverage through credit facilities or subscription lines. Furthermore, the institutional end investors, such as pension funds and insurers, may also employ leverage. This complex, multi-layered structure raises concerns because during a downturn, borrower vulnerabilities can lead to losses for funds and investors, forcing simultaneous reductions in exposure across the network, potentially triggering spillovers to other markets. Banks, as primary leverage providers to the funds, are exposed to collateral calls during periods of stress. The majority of private credit is housed in closed-end funds, where capital is locked up for years. This structure mitigates run risk. However, the growing trend of retailization, offering private credit to a broader investor base, including individuals, is introducing semi-liquid structures. Vehicles like business development companies, BDCs, and interval funds offer limited redemption windows while investing in illiquid underlying assets. Although these funds employ tools like gates and suspension clauses to manage redemptions, these tools have not been fully tested in a severe, systemic runoff scenario. A significant surge in investor redemptions, driven by panic or loss of confidence, could force a fund to sell illiquid assets at deep discounts, resulting in fire sales that erode investor returns. The critical debate among regulators and analysts is whether the risks in private credit are localized misfortunes or a threat to macro-financial stability. Private credit is deeply connected to traditional financial institutions. Banks partner with funds and provide them with leverage. Furthermore, pension funds and insurance companies, institutions responsible for massive amounts of public and private capital, are major investors. This interconnectedness creates potential contagion pathways. If losses in private credit require insurers and pension funds to sell off their liquid assets, such as government bonds, to cover those losses or meet capital calls, the stress could be transmitted to the broader financial system. Some insurance companies, especially those influenced by private equity firms, show weaker capital adequacy and elevated exposure to less liquid assets, heightening their vulnerability. Recent corporate failures, such as First Brands and Tricolor, highlighted how opaque financing structures involving hidden leverage and fabricated assets can lead to massive, unexpected losses. For example, the First Brands bankruptcy involved billions that simply vanished, revealing complex layered obligations. These events, even if individually small in nominal size, shatter the trust between funders and asset managers. This loss of confidence is crucial because debt markets rely on credibility. When trust breaks down, investors pull back, leading to a funding strike and a potential credit crunch that affects healthy companies across the real economy. Some analysts conclude that the current problems are not systemic in the sense of broken plumbing, but are systematic, the predictable consequence of carelessness, and a lowering of lending standards during long periods of prosperity. However, others caution that if the rapid opaque growth continues with limited oversight, the vulnerabilities of the industry could absolutely become systemic. The intense competition, fueled by huge amounts of committed but uninvested capital, referred to as dry powder, pressures managers to deploy money. This can lead to a deterioration of underwriting standards, evidenced by the reduction of financial maintenance covenants in deals, increasing the risk of credit losses. Given these risks, policymakers and regulators are actively debating how to monitor this growing sector. Key recommendations drawn from global financial stability reports focus on 1. Data gaps. Authorities must enhance reporting requirements across the value chain to assess hidden leverage, concentration, and interconnectedness. 2. Liquidity. Oversight. Stricter rules are needed for semi-liquid funds, including requiring longer notice periods for redemptions or favoring closed-end fund structures to mitigate run risks. 3. Valuation. Scrutiny. Close monitoring of valuation practices is necessary, with potential mandates for independent external valuations and audits to prevent conflicts of interest and misleading performance metrics. 4. Conduct risk. With increasing retail participation, supervisors must ensure stringent disclosure of high credit and liquidity risks and monitor potential mis-selling. Despite the benefits private credit offers by providing tailored long-term financing, its sheer size and structural intricacies make it a double-edged sword. Whether the historically high yields adequately compensate investors for the hidden, untested risks remains the critical, unanswered question. Private credit has successfully transformed from a niche alternative into a financial powerhouse, offering investors enhanced returns and providing critical financing to corporations overlooked by traditional banks. But we must remember the lesson of history. Good times lead to carelessness, and it is in the subsequent downturns that flaws are ruthlessly exposed. The system is now large and interconnected enough that we cannot afford to fly blind. What do you think is the biggest threat lurking in the private credit market? Do you agree that the long-term, locked-up nature of this capital provides sufficient protection against a major credit crisis? Let us know your thoughts in the comments below. And if you found this deep dive insightful, Make sure to like this video and subscribe for more analytical content designed to keep you informed about what happens in the financial world.